Welcome to this explainer, all right? Let's just dive right into it. Now, the absolute ultimate prize for any qualifying business in the UAE right now is that highly coveted 0% corporate tax rate. I mean, it is an incredible advantage. But as anyone who has actually looked at the Federal Tax Authority's new guidelines will tell you, achieving and maintaining that 0% status, well, it's a giant complex maze. The rules for becoming a qualifying free zone person, or QFFZ, are dense, intricate, and honestly, they're just full of hidden tripwires.
So, to safely navigate these really high-stakes tax rules without hitting a dead end, businesses absolutely need an expert guide. And that is exactly where Diraya Consulting Services LLC comes in. You can think of them as your expert cartographers for this entire UAE corporate tax labyrinth. The margins for error here are simply way too thin to go it alone, and getting professional help ensures you stay right on that path to the 0% benefit without suddenly triggering any unexpected penalties.
So here is our map for today's explainer. We're going to be covering 1. Unlocking 0% corporate tax, 2. The beneficial recipient test, 3. Surviving the de minimis trap, 4. Adequate substance and CIGA, 5. Qualifying versus excluded activities, and finally, 6. Managing branches and DPEs.
All right, kicking things off with Section 1, Unlocking 0% corporate tax, the ultimate prize. Now, the absolutely crucial point to understand here is that this 0% rate is a specific privilege reserved for registered companies operating in free zones. Natural persons or simple partnerships, they just don't qualify. You actually get this status by default, provided, of course, that you meet all the conditions and you don't explicitly opt in to the standard 9% regime.
Moving right along to Section 2, the beneficial recipient test for free zone to free zone transactions.
Now, this is where we hit our first real gray area in the maze. You might be thinking, hey, I'm simply selling from my free zone entity to another free zone entity, so I automatically qualify for 0%, right? Well, not so fast. The FTA applies a really strict definition here. The purchaser has to be the beneficial recipient. What that means is the goods or services must be for use by that specific free zone person. They can't just be passed through a conduit, an agent, or a mainland branch. To protect your 0% status, you actually need to evaluate if your purchaser is the true end user, which often means getting a formal written statement from them.
Okay, Section 3, surviving the de minimis trap, otherwise known as your margin for error.
Let's look at the part of the corporate tax guide that honestly keeps business owners up at night. We're talking about the razor-thin margin you have for earning non-qualifying revenue. The magic numbers here are 5% or 5 million dirhams. If your non-qualifying revenue exceeds either 5% of your total revenue or 5 million dirhams, whichever of those two is lower, you trigger a truly catastrophic penalty. Segregating your revenue buckets accurately isn't just a good idea, it is literally vital for your survival.
And here is exactly why that penalty is so devastating. It's called the 5-year taming rule. Let's say you accidentally breach that 5% limit in 2024. You don't just lose your 0% status for that 1 year. No. Your QFZP status is tainted for the current year plus the next 4 tax periods. So, from 2025 all the way through 2028, you are locked out of the 0% rate and subjected to the standard 9%. You can't even be retested for the qualifying status until January 1st, 2029. Let that sink in. A single slip-up costs you half a decade of tax benefits.
On to Section 4, adequate substance and CIGA, the core versus the shell. If there is one massive overarching theme in these FTA guidelines, it's this. Your business absolutely cannot just be a paper shell. It needs a beating heart. And that heart is your CIGA, or core income generating activities. These are the essential, value-adding functions that actually drive your sales and create your revenue. Now, while your routine admin stuff can happen elsewhere, your CIGA must occur entirely within the free zone. Because if the real value of your business is created on the outside, you simply won't qualify.
So the real trick is, how do you actually prove this? Well, you need adequate, full-time, qualified employees. And here's a really fascinating detail. If you have one employee working across 2 different core activities, you cannot double count them for the substance test. You also need your keyboard decisions to be made physically inside the free zone. Mere rubber stamping of decisions that were actually made abroad, yeah, that's not going to fly. And what if you outsource your core activities? You must have rigid, highly documented mechanisms to oversee the quality, the quantity, and the timelines of that outsourced work. You can't just hand it off to someone else and look the other way.
This brings us to Section 5, qualifying versus excluded activities. It's all about choosing the right path.
Think of this as a major fork in the maze because the very nature of your daily business dictates your tax rate. The FTA provides us with very specific lists. Qualifying activities, things like contract manufacturing, fund management, or even holding cryptocurrency for investment, those are going to keep you right on that 0% path. But on the flip side, excluded activities will derail your status entirely. We're talking about banking, owning non-commercial real estate, and almost all transactions with natural persons. Basically, that means everyday retail consumers, which is a rule specifically designed to protect mainland retail businesses. Choose the wrong activity, and you instantly taint your revenue.
Now, you might be wondering about a really critical question, one that a lot of ambitious businesses face as they grow. What happens if your free zone business expands and opens up a branch on the UAE mainland? Does your 0% status extend out to protect that new branch?
Well, that perfectly tees up Section 6, Managing Branches and DPEs, the mainland connection.
So, expanding to the mainland introduces a concept known as a domestic permanent establishment, or a DPE. And this fundamentally alters your entire tax landscape. Your free zone entity and your new mainland DPE are treated practically like two completely separate companies. The free zone retains its 0% potential, sure, but the DPE? That is subject to the standard 9% rate. And the FTA requires a very strict two-step functional analysis here. You have to allocate profits and compensate the DPE on what's called an arm's-length basis. In plain English, that means you have to price your internal dealings exactly as if you were doing business with an independent third-party company. No artificially shuffling your mainland profits back into the free zone just to avoid taxes.
Finally, let's look at the safe exit, partnering for compliance. As we reach the end of our journey today, I think it's pretty clear that this maze is packed with strict definitions and some truly terrifying penalties. But listen, a safe exit is absolutely possible, which brings us right back to why having the right partner is just indispensable. Diraya Consulting Services LLC provides that essential roadmap you need to track your qualifying income, maintain your adequate substance, ensure your transfer pricing is totally compliant, and ultimately secure that 0% benefit. These rules are just too rigid for guesswork, guys.
I want to leave you with this one final critical thought based on everything we've unpacked today. Take a really close look at your own business. Are your operations a true core with tangible substance and real decision-making happening within the free zone? Or, if you're being honest, are you operating just a shell, crossing your fingers and hoping you don't hit that de minimis trap? The time to evaluate your business substance is right now, before the FTA decides to do it for you. Thank you so much for joining me for this explainer, and I wish you the best of luck navigating the maze.